Hey everyone, this week I have some good news and some bad news. The good news is that the US economy is showing signs of reinvigorated growth. In previous videos, I've highlighted rising consumer sentiment and small business optimism, but we're also seeing growth in other areas. December job creation beat expectations with the creation of 256,000 new positions. That comes on the heels of 212,000 jobs added in November. In addition, it looks like holiday retail sales beat expectations, growing by about 3.8% compared to last year. It looks like the green shoots of growth have begun to grow. Now, for the not so good news. Those signs of growth, together with some prospective policy changes, run the risk of reigniting inflation. And as a result, we've been seeing upward pressure on interest rates. Since the beginning of the year, the 10-year Treasury has risen by close to 20 basis points, reaching 4.8% last week. Now, predicting the 10-year Treasury is exceptionally difficult, so I'm not going to offer a 2025 10-year Treasury prediction, but I will share some of the key guideposts that I'll be watching. I'll start with the forces that generally put upward pressure on the Treasury rate. First and foremost is, of course, inflation. If we see meaningful upward movement in the Consumer Price Index or the Personal Consumption Expenditure readings, we'll likely see the 10-year move higher. But there are inflation precursors we can monitor as well, like job openings, falling unemployment, and outsized job additions. I think the Fed would really like to see job additions averaging around 150,000 per month, give or take. If the 3-month average pace of job creation runs north of 175,000, that may be considered too much and put upward pressure on the 10-year Treasury. Other metrics to keep an eye on include retail sales and the Institute of Supply Chain Management indexes for manufacturing and non-manufacturing. A material jump in any of these metrics could be viewed as a precursor to accelerating growth and accelerated inflation risk. I'm also watching what happens with campaign trail public policy plans like increased tariffs, reduced taxes, increased immigration controls, and deregulation. Any one of those policies could potentially put upward pressure on inflation. And they're the kinds of things that could move the needle on Treasury rates. One other metric to keep an eye on is the issuance of treasuries. If the federal deficit increases, treasuries will be issued to borrow money, and issuing more treasuries puts upward pressure on interest rates. For the other side of the coin, some things could put downward pressure on Treasury rates. Many of these forces are the inverse of metrics that put upward pressure on rates. So if unemployment rises or job creation falls, that could put increased pressure on the Federal Reserve to cut rates. Likewise, if retail sales stall out or the ISM indexes drop substantively, those could be signs of an economic slowdown, and there'd be downward pressure on the 10-year Treasury. Another thing that could push the 10-year lower would be a flight to safety from the stock market. If for some reason there's a flight to safety and money flows out of the stock market, a significant portion could move into bonds, which would put downward pressure on interest rates. Another driver that could put downward pressure on interest rates would be if the Federal Reserve were to end its quantitative tightening program. Right now, the Federal Reserve's trying to shrink its balance sheet by allowing $25 billion of treasuries and other investments to burn off each month. Basically, as Fed holdings like treasuries mature, the Fed is not replacing them by buying new ones. So if the Federal Reserve ended its quantitative tightening program, then they'd theoretically buy about $25 billion worth of treasuries and similar investments each month. And that would increase demand for treasuries and put downward pressure on interest rates. Now, from a commercial real estate investment standpoint, we already have a pricing expectation gap between buyers and sellers. And in many cases, the cost to borrow money for real estate purchases is higher than the yield. And investors generally don't like going into an investment with negative leverage. That could continue to put upward pressure on cap rates further reducing property values. As I've said in the past, these are likely short-term obstacles. Fundamentally, the supply-demand outlook for most types of commercial real estate remains positive, with demand strengthening and the pace of supply additions slowing. So while the short-term math has the hurdles of negative leverage, over the long term, the supply and demand balance looks really positive. For most property types, new supply will not keep up with demand over the long term. And as always, investors may want to focus more on the long term. Interest rates may prove to be bumpy in 2025, and if rates drops, investors could refinance at a lower rate, but they'll still have the upside potential of the long-term supply and demand imbalance. And that's why I always remind investors to keep your eyes on the horizon.